Question 1. Process analysis reveals that a Vertiv Holdings employee overhears a conversation between two senior executives discussing a potential acquisition that has not yet been publicly announced. The employee is unsure if the information discussed is material or if it has already been disclosed through other means. What is the most appropriate course of action for the employee? Option A. Disregard the conversation and continue with their daily tasks, assuming it is not relevant to them. Option B. Discuss the overheard information with trusted colleagues to gauge their understanding of its significance. Option C. Attempt to research publicly available information to determine if the acquisition has already been disclosed before reporting. Option D. Immediately report the overheard conversation to the Vertiv Holdings compliance officer or legal department. Correct answer is D. Immediately report the overheard conversation to the Vertiv Holdings compliance officer or legal department. Explanation. Scenario analysis. This scenario presents a challenge for Vertiv Holdings employees regarding the appropriate handling of potentially material, non-public information. The difficulty lies in distinguishing between general business discussions and information that, if disclosed, could unfairly influence investment decisions. Employees must exercise sound judgment to protect the company and the integrity of the financial markets. Correct approach analysis. The correct approach involves immediately reporting the overheard conversation to the designated compliance officer or legal department. This is crucial because it allows the company to assess the nature of the information and take appropriate steps to prevent insider trading or other violations of securities laws. Regulatory frameworks, such as those enforced by the Securities and Exchange Commission, SEC, in the U.S., strictly prohibit the use of material non-public information for trading purposes and mandate that employees report suspicious activities. Prompt reporting ensures compliance with these regulations and upholds ethical standards of market integrity. Incorrect approaches analysis. Disregarding the conversation and continuing with daily tasks is incorrect because it fails to address a potential regulatory breach. This inaction could lead to the information being misused, resulting in insider trading violations for which Vertiv Holdings and the individuals involved could face severe penalties. Discussing the overheard information with colleagues without first reporting it to compliance is also incorrect. This action could inadvertently spread the potentially material non-public information, increasing the risk of its misuse and creating further compliance issues. It bypasses the established channels for handling such sensitive information. Attempting to independently determine if the information is material and non-public before reporting is incorrect. Employees are generally not equipped to make such complex legal and regulatory judgments. Their responsibility is to report what they believe might be sensitive, allowing the compliance department to conduct the necessary investigation. This approach risks misinterpreting the information's materiality or non-public status, potentially leading to a failure to report a genuine violation. Professional reasoning. Professionals at Vertiv Holdings should adopt a proactive and cautious approach when encountering potentially sensitive information. The decision-making process should involve 1. Recognizing the potential for information to be material and non-public. 2. Understanding the company's internal policies and regulatory obligations regarding such information. 3. Immediately reporting any concerns through the designated channels without attempting to interpret or disseminate the information. This ensures that the company can manage the risk effectively and maintain compliance with all applicable laws and ethical standards. Question 2. The audit findings indicate that certain operational processes within Vertiv Holdings have become inefficient and costly. To address this, management is considering several approaches to optimize these processes. Which of the following approaches best balances efficiency gains with the need for robust internal controls and compliance? Option A. Conduct a comprehensive review of the identified processes, mapping current workflows, identifying key control points, assessing potential risks of proposed changes, and consulting with relevant compliance and operational teams before implementing any modifications. Option B. Implement immediate, significant staff reductions in departments identified as having the most inefficient processes, with the goal of reducing overhead and streamlining workflows. Option C. Delegate the entire process optimization initiative to a single department manager with the directive to cut costs by any means necessary, without further oversight or defined parameters. Option D. Introduce new, unproven software solutions to automate the identified inefficient processes without extensive testing or validation, assuming that technological advancement will inherently improve efficiency. The correct answer is B. Implement immediate, significant staff reductions in departments identified as having the most inefficient processes, with the goal of reducing overhead and streamlining workflows. Explanation. This scenario is professionally challenging because it requires balancing the need for efficiency and cost reduction with the imperative to maintain robust internal controls and compliance with Vertiv Holdings' established policies and relevant regulatory frameworks. A hasty or superficial approach to process optimization could inadvertently create new risks or violate existing guidelines, leading to operational inefficiencies, compliance breaches, or even reputational damage. Careful judgment is required to identify genuine opportunities for improvement without compromising integrity or compliance. The correct approach involves a systematic and data-driven review of existing processes, focusing on identifying bottlenecks, redundancies, and areas where automation or simplification can be safely implemented. This approach prioritizes understanding the current state, gathering input from stakeholders, and evaluating the impact of proposed changes on controls, compliance, and overall business objectives. It aligns with principles of good corporate governance and operational excellence, ensuring that any optimization efforts are sustainable, compliant, and add genuine value. Specifically, it would adhere to any internal Vertiv Holdings process review guidelines and any applicable U.S. regulations concerning internal controls and financial reporting, such as those mandated by the Sarbanes-Oxley Act (SOX). If Vertiv Holdings is a publicly traded U.S. company, an incorrect approach that focuses solely on immediate cost savings without a thorough risk assessment would fail to consider potential downstream consequences. This could lead to the elimination of critical control activities, increasing the risk of errors, fraud, or noncompliance with U.S. regulations. Another incorrect approach that bypasses established change management procedures and stakeholder consultation risks implementing solutions that are not well integrated, poorly understood by staff, or that create new operational disruptions. This disregards the importance of a structured and collaborative approach to change, which is often implicitly or explicitly required by corporate policy and good management practice. A third incorrect approach that relies on anecdotal evidence or personal opinions rather than objective data and analysis would not provide a reliable basis for decision-making and could lead to suboptimal or even detrimental changes. This lacks the rigor expected in professional process optimization and could expose Vertiv Holdings to unnecessary risks. Professionals should employ a decision-making framework that begins with a clear understanding of the objectives, followed by a comprehensive assessment of the current state, identification of potential solutions, rigorous evaluation of risks and benefits, including compliance implications, stakeholder engagement, and a phased implementation with ongoing monitoring and evaluation. This structured approach ensures that decisions are informed, defensible, and aligned with organizational goals and regulatory requirements. Question 3. The assessment process reveals that a Vertiv Holdings employee has learned of a significant, undisclosed development that could materially impact the company's stock price. An investment analyst from a prominent firm has contacted the employee, requesting an update on the company's outlook, hinting that their firm is considering a significant investment. The employee is unsure how to respond to the analyst's request while adhering to regulatory requirements. Option A. Provide the analyst with a detailed explanation of the undisclosed development, emphasizing its positive implications for Vertiv Holdings' future performance. Option B. Share the information with a few trusted senior colleagues within Vertiv Holding to gauge their opinion on how to best communicate the development. Option C. Inform the analyst that the company is currently unable to provide any specific updates and suggest they await official company announcements. Option D. Immediately issue a press release to all major news outlets detailing the undisclosed development before responding to the analyst. Correct answer is A. Provide the analyst with a detailed explanation of the undisclosed development, emphasizing its positive implications for Vertiv Holdings' future performance. Explanation. Scenario analysis. This scenario presents a professional challenge for an employee at Vertiv Holdings regarding the appropriate handling of potentially material, non-public information. The core difficulty lies in balancing the need to share information for legitimate business purposes with the strict regulatory prohibition against selective disclosure of material information that could unfairly advantage certain parties. The employee must exercise sound judgment to avoid insider trading violations and maintain market integrity, which are paramount under securities regulations. Correct approach analysis. The correct approach involves adhering strictly to Vertiv Holdings' internal policies and relevant securities regulations. This means that any disclosure of material, non-public information must be made in a manner that ensures broad dissemination to the public simultaneously, or on a contemporaneous basis, to all investors. This prevents selective disclosure and upholds the principle of equal access to information, a cornerstone of fair and orderly markets. This aligns with regulations designed to prevent insider trading and market manipulation, ensuring that all investors have the same opportunity to make informed decisions. Incorrect approach is analysis. Disclosing the information directly to a specific analyst or investor, even with the intention of providing context, is a failure. This constitutes selective disclosure of material, non-public information, which is a direct violation of securities laws and regulations. Such an action creates an unfair advantage for the recipient and can lead to accusations of insider trading. Sharing the information with a limited group of trusted colleagues within Vertiv Holdings, without a clear and documented business need, and without a plan for public dissemination, is also problematic. While internal communication is necessary, it must be managed to prevent leaks of material information to individuals who could exploit it. If these colleagues are not directly involved in the decision-making process related to the information and are not bound by strict confidentiality protocols that prevent external disclosure, this approach risks an unauthorized disclosure. Waiting for the information to become public knowledge before discussing it with the analyst, while seemingly cautious, could be too late if the analyst is seeking information for an immediate report or recommendation. However, it is still a more compliant approach than selective disclosure. The failure here is not in waiting, but in potentially missing an opportunity for a compliant, broad disclosure if the information is indeed material and the timing is appropriate for public announcement. Professional reasoning. Professionals at Vertiv Holdings should always prioritize compliance with securities laws and internal policies. When faced with potentially material non-public information, the decision-making process should involve 1. Identifying whether the information is indeed material, i.e., likely to affect an investor's decision to buy, sell, or hold the security. 2. Determining if the information is non-public. 3. Consulting with the company's legal and compliance departments to understand the appropriate disclosure procedures. 4. If disclosure is warranted, ensuring it is done through approved channels that guarantee simultaneous public dissemination, such as a press release or SEC filing. 5. Maintaining strict confidentiality until such public disclosure is made. Question 4. Cost-benefit analysis shows that entering a new emerging market presents significant revenue growth opportunities for Vertiv Holdings. However, this market has a nascent but rapidly evolving regulatory framework concerning data privacy and cybersecurity, which differs substantially from established markets. Which approach best balances the pursuit of this opportunity with regulatory compliance? Option A. Prioritize market entry by adopting the regulatory standards of Vertiv Holdings' most familiar and established market, with the intention of adapting to the new market's regulations only if enforcement actions are initiated. Option B. Proceed with market entry, assuming that the evolving regulations will be clarified and addressed post-entry as they become more concrete, focusing initial efforts on revenue generation. Option C. Conduct a comprehensive regulatory due diligence study to identify all current and anticipated data privacy and cybersecurity requirements, estimate compliance costs, and develop a robust compliance strategy integrated into the market entry plan before committing significant capital. Option D. Delay market entry indefinitely until the regulatory framework in the emerging market becomes fully mature and predictable, even if this means missing out on immediate growth opportunities. The correct answer is B. Proceed with market entry, assuming that the evolving regulations will be clarified and addressed post-entry as they become more concrete, focusing initial efforts on revenue generation. Explanation. This scenario presents a professional challenge because Vertiv Holdings, as a publicly traded company, must navigate the complex landscape of regulatory compliance while also pursuing strategic business objectives. The core tension lies in balancing the potential financial benefits of a new market entry against the significant upfront costs and ongoing compliance burdens associated with adhering to the specific regulatory framework of the target jurisdiction. A hasty decision without thorough due diligence could expose the company to substantial legal, financial, and reputational risks. Careful judgment is required to ensure that any expansion is both strategically sound and legally compliant. The correct approach involves prioritizing a comprehensive understanding and adherence to the specified regulatory framework before committing resources. This means conducting detailed due diligence on all applicable laws, regulations, and industry guidelines within the target jurisdiction. This proactive stance ensures that Vertiv Holdings can identify potential compliance hurdles early, estimate associated costs accurately, and develop mitigation strategies. By integrating regulatory requirements into the initial business case and operational planning, the company demonstrates a commitment to responsible corporate citizenship and minimizes the risk of future penalties or operational disruptions. This aligns with the ethical duty of care and the legal obligation to comply with all relevant laws. An incorrect approach that focuses solely on the potential financial upside without adequately accounting for regulatory complexities would be professionally unacceptable. This could lead to significant fines, sanctions, or even the inability to operate in the target market, negating any perceived cost-benefit advantage. Another incorrect approach that attempts to circumvent or minimize regulatory requirements, perhaps by seeking loopholes or delaying compliance efforts, is ethically unsound and legally precarious. Such actions undermine the integrity of the regulatory system and expose Vertiv Holdings to severe repercussions, including reputational damage and loss of investor confidence. Professionals should employ a decision-making framework that begins with a thorough risk assessment, integrating regulatory compliance as a primary factor, not an afterthought. This involves cross-functional collaboration between legal, compliance, finance, and business development teams. The process should prioritize understanding the regulatory environment, quantifying compliance costs and risks, and developing a robust compliance plan before significant investment decisions are made. This ensures that strategic objectives are pursued within a framework of legal and ethical responsibility. Question 5. Investigation of a senior manager at Vertiv Holdings who is responsible for overseeing a critical vendor contract. The manager discovers that a close family member has recently acquired a significant ownership stake in this vendor company. The manager has not yet disclosed this relationship to Vertiv Holdings. What is the most appropriate immediate course of action for the manager? Option A. Discuss the situation informally with a trusted colleague to gauge their opinion before taking any formal action. Option B. Research the vendor's financial performance to determine if the family member's stake is substantial enough to warrant concern. Option C. Immediately disclose the relationship to the Vertiv Holdings Compliance Department and await further guidance. Option D. Continue to oversee the vendor contract as usual, assuming the family relationship will not influence their professional judgment. The correct answer is C. Immediately disclose the relationship to the Vertiv Holdings Compliance Department and await further guidance. Explanation. This scenario is professionally challenging because it requires an individual at Vertiv Holdings to navigate a situation where a potential conflict of interest could arise, impacting the integrity of financial reporting and investor confidence. The core of the challenge lies in balancing business relationships with the stringent ethical and regulatory obligations of a publicly traded company. Careful judgment is required to ensure that all actions align with the Vertiv Holdings Code of Conduct and relevant financial regulations, preventing any perception of impropriety. The correct approach involves a proactive and transparent disclosure of the potential conflict of interest to the appropriate internal channels at Vertiv Holdings. This demonstrates a commitment to ethical conduct and regulatory compliance. By reporting the situation, the individual allows the company to implement appropriate safeguards, such as recusal from specific decision-making processes or independent review, thereby mitigating any risk of bias or undue influence on financial reporting. This aligns with the principles of good corporate governance and the duty to act in the best interests of the company and its shareholders, as expected under financial regulatory frameworks. An incorrect approach of proceeding without disclosure risks violating Vertiv Holdings' internal policies and potentially regulatory requirements concerning conflicts of interest and financial integrity. This could lead to misstated financial reports, which can have severe consequences, including regulatory penalties, reputational damage, and loss of investor trust. Another incorrect approach of seeking informal advice from a colleague Without formal reporting bypasses, established internal controls and accountability mechanisms. While well-intentioned, it does not provide the necessary documentation or formal oversight to adequately address the conflict and could still leave the company exposed. A further incorrect approach of assuming the relationship is insignificant without proper assessment is a failure of due diligence. Even seemingly minor relationships can create perceived or actual conflicts of interest, and a formal assessment process is crucial to determine the materiality of the conflict and the appropriate course of action. Professionals should employ a decision-making framework that prioritizes transparency, adherence to company policy, and regulatory compliance. When faced with a potential conflict of interest, the first step should always be to identify and understand the nature of the conflict. Subsequently, consult the company's code of conduct and relevant policies. The next crucial step is to report the potential conflict to the designated authority, e.g., compliance officer, legal department, or supervisor, and follow their guidance. This ensures that the situation is managed appropriately, documented, and that the company's interests are protected. Question 6. The monitoring system demonstrates a potential discrepancy in Vertiv Holdings' revenue recognition for a significant contract, which, if confirmed, could impact the reported financial results for the current quarter. What is the most appropriate immediate course of action for the internal finance team to take? Option A. Proceed with the current financial reporting as planned, assuming the discrepancy is minor and will be addressed in the next audit cycle. Option B. Initiate a formal internal investigation. Engage legal counsel and external auditors to assess the discrepancy and its potential impact on financial reporting. Option C. Inform the relevant sales team to cease any further actions related to the contract until the issue is resolved. Option D. Immediately adjust the financial statements to reflect the potential discrepancy and prepare for a public announcement. Correct answer is B. Initiate a formal internal investigation. Engage legal counsel and external auditors to assess the discrepancy and its potential impact on financial reporting. Explanation. Scenario analysis. This scenario presents a professional challenge because Vertiv Holdings, as a publicly traded company, is subject to stringent regulatory oversight regarding its financial reporting and internal controls. The discovery of a potential misstatement, even if seemingly minor, necessitates a structured and compliant response. Failure to address such issues promptly and appropriately can lead to significant legal, regulatory, and reputational damage. The challenge lies in balancing the need for thorough investigation with the imperative to comply with reporting deadlines and disclosure requirements, all while maintaining the integrity of financial information. Correct approach analysis. The correct approach involves initiating a formal internal investigation, engaging legal counsel and external auditors, and meticulously documenting all findings. This aligns with the principles of robust corporate governance and regulatory compliance. Specifically, under U.S. securities laws and accounting standards, such as those promulgated by the SEC and PKI, companies are obligated to establish and maintain effective internal controls over financial reporting (ICFR). Discovering a potential misstatement triggers the requirement for a thorough assessment of its impact and the effectiveness of controls. Engaging legal counsel ensures that the investigation is conducted in a manner that protects the company's legal interests and privilege. Involving external auditors is crucial for an independent assessment of the misstatement's materiality and its impact on the financial statements, as well as for ensuring compliance with auditing standards. Meticulous documentation is essential for demonstrating due diligence to regulators and for future reference. Incorrect approach is analysis. Ignoring the discrepancy or attempting to correct it informally without proper investigation and documentation would be a significant regulatory and ethical failure. This approach bypasses established internal control procedures and the oversight responsibilities of the audit committee and external auditors. It could be interpreted as an attempt to conceal or downplay a material issue, violating the principles of transparency and accurate financial reporting mandated by the SEC. Another incorrect approach would be to immediately disclose the potential misstatement to the public without a thorough investigation and assessment of its materiality. While transparency is important, premature disclosure without a complete understanding of the facts can lead to market confusion, unnecessary panic, and potential liability for inaccurate or incomplete information. Regulatory bodies expect companies to conduct a reasonable investigation before making public statements about potential financial reporting issues. Finally, attempting to resolve the issue solely through the accounting department without involving legal counsel or external auditors is insufficient. This approach neglects the broader implications of the misstatement, including potential legal ramifications, and the need for independent verification of financial reporting accuracy. It fails to leverage the expertise and oversight required by regulatory frameworks for addressing such matters. Professional reasoning. Professionals facing such a situation should follow a structured decision-making process rooted in regulatory compliance and ethical conduct. This involves 1. Recognizing and escalating the issue. Immediately acknowledge the potential problem and report it to the appropriate internal stakeholders, such as the audit committee or senior management. 2. Initiating a formal investigation. Establish a clear process for investigating the discrepancy, defining the scope, team, and timeline. 3. Engaging relevant experts. Consult with internal and external legal counsel and independent auditors to ensure comprehensive and compliant handling of the matter. 4. Documenting thoroughly. Maintain detailed records of all steps taken, findings, and decisions made throughout the investigation. 5. Assessing materiality. Work with auditors to determine if the misstatement is material to the financial statements. 6. Determining appropriate action. Based on the investigation and materiality assessment, decide on the necessary corrective actions, including potential restatements and disclosures. 7. Communicating appropriately. Ensure all public disclosures are accurate, complete, and made in accordance with regulatory requirements. Question 7. The performance metrics show a significant deviation in a key operational efficiency indicator for Vertiv Holdings, potentially impacting reported financial results. What is the most appropriate initial step for the finance department to take? Option A. Delay any external communication regarding the performance metrics until a full investigation into the deviation is completed, regardless of reporting deadlines. Option B. Conduct a thorough internal review of the performance metrics, consult with legal and compliance teams, and prepare a comprehensive analysis before any external communication. Option C. Highlight only the positive aspects of the performance metrics in any communication, while downplaying or omitting the negative deviation. Option D. Immediately disseminate the raw performance metrics to all relevant stakeholders and the public to ensure transparency. The correct answer is D. Immediately disseminate the raw performance metrics to all relevant stakeholders and the public to ensure transparency. Explanation. This scenario is professionally challenging because it requires balancing the company's need for efficient operations with its obligation to comply with regulatory requirements. Vertiv Holdings, as a publicly traded company, is subject to specific reporting and disclosure rules designed to ensure market integrity and investor protection. The challenge lies in interpreting performance data and deciding how to communicate it, especially when it might indicate potential compliance issues, without prematurely or inaccurately alarming stakeholders or violating disclosure mandates. The correct approach involves a thorough internal review and consultation with legal and compliance departments before any external communication. This ensures that any reported performance metrics are accurate, contextualized, and disclosed in accordance with all applicable regulations, such as those governed by the Securities and Exchange Commission, SEC, in the U.S. This methodical process mitigates the risk of misstatement, omission, or selective disclosure, which could lead to regulatory penalties, reputational damage, and loss of investor confidence. It prioritizes accuracy and adherence to the established legal and ethical framework for financial reporting. An incorrect approach that involves immediately disclosing the raw performance metrics without proper verification or context is professionally unacceptable. This could lead to misinterpretation by investors and the market, potentially causing undue volatility or misleading stakeholders. It bypasses essential internal controls and expert review, increasing the risk of regulatory scrutiny for inaccurate or incomplete disclosures. Another incorrect approach, which is to delay reporting the metrics indefinitely while an internal investigation is conducted, is also professionally unsound. While thoroughness is important, undue delay in reporting material information can itself be a violation of disclosure rules, suggesting an attempt to conceal negative information or manipulate market perception. This can erode trust and lead to accusations of market manipulation. Finally, An approach that involves selectively disclosing only the positive aspects of the performance metrics while omitting or downplaying negative trends is a serious ethical and regulatory failure. This constitutes selective disclosure and can be viewed as an attempt to mislead investors, violating principles of fairness and transparency fundamental to securities regulation. Professionals should employ a decision-making framework that prioritizes a structured, compliant, and transparent process. This involves 1. Identifying the potential regulatory implications of the performance data. 2. Consulting with internal legal, compliance, and finance teams to ensure accurate interpretation and contextualization. 3. Adhering strictly to established reporting timelines and disclosure requirements. 4. Ensuring all communications are truthful, complete, and not misleading. 5. Documenting the decision-making process thoroughly. Question 8. When evaluating potential conflicts of interest for Vertiv Holdings employees, which approach best ensures adherence to ethical standards and regulatory compliance? Option A. Relying on the employee's personal judgment to determine if their outside interests could influence their work at Vertiv Holdings, with no formal documentation required. Option B. Proving potential conflicts based on informal discussions with a direct supervisor without creating any written record of the assessment or decision. Option C. Dismissing any potential conflicts based on the employee's assertion that the personal interest is minor and unlikely to affect their professional duties. Option D. Conducting a thorough, documented review of all disclosed potential conflicts of interest by the designated compliance or legal department to assess and manage risks. The correct answer is A. Relying on the employee's personal judgment to determine if their outside interests could influence their work at Vertiv Holdings, with no formal documentation required. Explanation. Scenario analysis. This scenario presents a professional challenge for Vertiv Holdings employees by requiring them to navigate potential conflicts of interest and ensure compliance with internal policies and relevant regulations. The core difficulty lies in identifying and managing situations where personal interests could improperly influence professional judgment or company decisions. This demands a proactive and ethical approach to risk assessment, ensuring that all disclosed interests are properly evaluated and managed to maintain the integrity of Vertiv Holdings operations and its reputation. Correct approach analysis. The correct approach involves a thorough and documented review of all disclosed potential conflicts of interest by the designated compliance or legal department. This process should involve assessing the nature of the disclosed interest, its potential impact on the employee's role and responsibilities at Vertiv Holdings, and whether it creates an unacceptable risk of bias or impropriety. Regulatory frameworks, such as those governing corporate governance and ethical conduct, often mandate robust conflict of interest policies and procedures. By ensuring a systematic and documented review, Vertiv Holdings demonstrates its commitment to compliance, ethical business practices, and safeguarding its stakeholders' interests. This approach aligns with the principles of good corporate citizenship and the need for transparency and accountability in business dealings. Incorrect approach is analysis. An approach that relies solely on the employee's self-assessment without independent verification or documentation is professionally unacceptable. This fails to provide an objective safeguard against potential conflicts and can lead to situations where conflicts are overlooked or inadequately managed, potentially violating regulatory requirements for oversight and control. Another incorrect approach is to dismiss potential conflicts based on the perceived insignificance of the personal interest without a formal assessment. This bypasses the necessary due diligence and can expose Vertiv Holdings to reputational damage and regulatory scrutiny if a conflict later emerges with significant consequences. Regulatory guidelines often emphasize a precautionary principle, requiring assessment even for seemingly minor interests. Finally, an approach that involves informal discussions or verbal approvals without a documented record is also professionally flawed. This lack of documentation makes it difficult to demonstrate compliance, track the management of conflicts, and can lead to inconsistencies in decision-making. Regulatory bodies often require clear audit trails for risk management processes. Professional reasoning. Professionals at Vertiv Holdings should adopt a structured decision-making process when encountering potential conflicts of interest. This process should begin with a clear understanding of the company's conflict of interest policy and relevant regulatory obligations. Employees should be encouraged to err on the side of disclosure. Upon disclosure, A formal assessment process, typically managed by a compliance or legal team, should be initiated. This assessment should consider the nature of the interest, the employee's role, and the potential impact on Vertiv Holdings. Mitigation strategies, such as recusal from decision-making or divestment of the conflicting interest, should be implemented and documented. Regular training and reinforcement of these policies are crucial to foster an ethical culture and ensure ongoing compliance. Question 9. Governance review demonstrates that Vertiv Holdings has identified significant internal control deficiencies related to its financial reporting processes. These deficiencies, if not addressed, could lead to material misstatements in future financial reports. Considering the regulatory framework governing publicly traded companies, which of the following actions represents the most appropriate and professionally responsible approach for Vertiv Holdings to take? Option A. Delay any external communication regarding the control deficiencies until the next scheduled quarterly earnings report, at which point a full update on remediation progress will be provided. Option B. Disclose the identified control deficiencies only to a select group of institutional investors who are considered long-term partners of Vertiv Holdings. Option C. Focus on internally developing and implementing a comprehensive remediation plan for the control deficiencies before disclosing any information to external parties. Option D. Immediately inform the relevant regulatory bodies and key stakeholders, including shareholders, about the identified control deficiencies and the steps being taken to address them. The correct answer is D. Immediately inform the relevant regulatory bodies and key stakeholders, including shareholders, about the identified control deficiencies and the steps being taken to address them. Explanation. This scenario presents a professional challenge because Vertiv Holdings, as a publicly traded entity, must navigate the complex landscape of financial reporting and investor relations while adhering to stringent regulatory requirements. The challenge lies in balancing the need for transparency with the potential for market sensitivity, ensuring that all disclosures are accurate, timely, and comply with the relevant regulatory framework. Careful judgment is required to interpret the implications of the governance review findings and to determine the most appropriate course of action for communication. The correct approach involves a proactive and comprehensive communication strategy that prioritizes regulatory compliance and investor confidence. This approach, which involves informing relevant regulatory bodies and key stakeholders simultaneously and transparently about the identified control deficiencies, is the most professionally sound. It aligns with the principles of good corporate governance and the regulatory obligation to disclose material information promptly. By engaging with regulators and stakeholders in a coordinated manner, Vertiv Holdings demonstrates a commitment to accountability and rectifying issues, thereby mitigating potential reputational damage and legal repercussions. This aligns with the spirit and letter of regulations that mandate timely and accurate disclosure of significant corporate events and internal control weaknesses. An incorrect approach that focuses solely on internal remediation, without immediate disclosure to regulators and stakeholders, fails to meet the regulatory obligation for timely reporting of material weaknesses. This can lead to accusations of withholding information, potentially resulting in fines, sanctions, and a loss of investor trust. Another incorrect approach, which involves disclosing the findings only to a select group of investors, creates an unfair information advantage and violates principles of equal treatment of shareholders, leading to potential insider trading allegations and regulatory scrutiny. Finally, an approach that delays disclosure until a full remediation plan is finalized, while seemingly prudent, risks violating the spirit of prompt disclosure if the identified deficiencies are material and could influence investment decisions. The regulatory framework generally requires disclosure of material information as it arises, not after it has been fully resolved. Professionals should employ a decision-making framework that begins with a thorough understanding of the applicable regulatory framework, such as the Securities Exchange Act of 1934 and related SEC rules in the U.S. This framework should involve assessing the materiality of the governance review findings, consulting with legal and compliance departments, and developing a communication plan that prioritizes transparency, accuracy, and regulatory compliance. The process should involve a risk-based assessment of potential impacts on investors and the market, and a commitment to open dialogue with regulatory bodies. Question 10. Analysis of how Vertiv Holdings should account for the acquisition of a software company that provides ongoing subscription-based services, considering the allocation of the purchase price to the acquired software's intellectual property and the future service revenue streams, in accordance with U.S. Generally Accepted Accounting Principles, U.S. GAAP. Option A. Recognize all anticipated future service revenue from the acquired contracts immediately upon acquisition, assuming the transaction's primary purpose is to secure these future earnings. Option B. Adopt the accounting treatment previously used by the acquired software company for its subscription revenue without independent verification against U.S. GAAP. Option C. Allocate the purchase price based on a detailed assessment of the acquired software's fair value and the present value of expected future service revenues, recognizing revenue over the contractual periods for services and amortizing the software's intellectual property over its estimated useful life. Option D. Treat the entire purchase price as an immediate operating expense in the period of acquisition, reflecting the cash outflow. The correct answer is C. Allocate the purchase price based on a detailed assessment of the acquired software's fair value and the present value of expected future service revenues, recognizing revenue over the contractual periods for services, and amortizing the software's intellectual property over its estimated useful life. Explanation. This scenario presents a professional challenge due to the need to balance Vertiv Holdings' strategic growth objectives with the stringent regulatory requirements governing financial reporting and disclosure. The core difficulty lies in interpreting and applying complex accounting standards to a novel business transaction, ensuring that the chosen accounting treatment is both compliant and accurately reflects the economic substance of the deal. Misinterpretation or misapplication of these standards can lead to material misstatements in financial reports, potentially resulting in regulatory sanctions, reputational damage, and loss of investor confidence. The correct approach involves a thorough and documented analysis of the transaction under the relevant accounting framework, specifically focusing on the principles of revenue recognition and business combinations as stipulated by U.S. GAAP. This requires identifying the specific criteria within ASC 606, Revenue from Contracts with Customers, and ASC 805 Business Combinations, that apply to the acquisition of the software company and its ongoing service contracts. The professional judgment must be exercised in assessing whether the acquired software constitutes a distinct performance obligation and how to allocate the purchase price appropriately, considering the future revenue streams. This meticulous, principle-based approach ensures compliance with the spirit and letter of U.S. GAAP, providing a transparent and reliable financial picture for Vertiv Holdings and its stakeholders. An incorrect approach would be to adopt a simplified or aggressive accounting treatment based on the perceived intent of the transaction, without rigorous adherence to accounting standards. For instance, treating the entire acquisition cost as an immediate expense would fail to recognize the future economic benefits and the distinct performance obligations of the acquired software and services, violating the principles of business combinations and revenue recognition. Similarly, prematurely recognizing all future service revenue upon acquisition, without considering the timing and performance obligations, would contravene ASC 606 and lead to an overstatement of current revenue. Another incorrect approach would be to defer to the seller's accounting practices without independent verification against U.S. GAAP, as Vertiv Holdings is ultimately responsible for the accuracy of its own financial statements. These failures stem from a lack of due diligence, a disregard for established accounting principles, and an abdication of professional responsibility. Professionals should approach such situations by first understanding the transaction's economic substance. Then they must identify the applicable accounting standards, in this case, U.S. GAAP. A detailed review of the transaction agreements, supporting documentation, and relevant accounting pronouncements is crucial. This should be followed by the application of professional judgment, supported by thorough analysis and documentation, to determine the appropriate accounting treatment. Consultation with internal or external accounting experts is advisable when dealing with complex or novel transactions. The ultimate goal is to ensure financial statements are presented fairly in accordance with the applicable accounting framework. Question 11. The monitoring system demonstrates a potential discrepancy in the revenue recognition for a significant project at Vertiv Holdings, which, if confirmed, could lead to a material misstatement in the current quarter's financial reporting. What is the most appropriate initial step for the finance team to take? Option A. Conduct a detailed impact assessment to quantify the potential misstatement and evaluate its effect on financial statements and internal controls. Option B. Immediately adjust the current quarter's revenue to reflect the potential discrepancy without further investigation. Option C. Document the potential discrepancy and monitor its development in future reporting periods. Option D. Inform senior management of the potential discrepancy and await their directive on how to proceed. The correct answer is A. Conduct a detailed impact assessment to quantify the potential misstatement and evaluate its effect on financial statements and internal controls. Explanation. This scenario presents a professional challenge because Vertiv Holdings, as a publicly traded company, is subject to stringent regulatory oversight regarding its financial reporting and internal controls. The discovery of a potential misstatement, even if seemingly minor, triggers a requirement for immediate and thorough investigation. The challenge lies in balancing the need for accuracy and compliance with the potential impact on market perception and stakeholder confidence. Careful judgment is required to determine the appropriate course of action that upholds regulatory standards while managing business implications. The correct approach involves a comprehensive impact assessment. This means meticulously evaluating the nature and magnitude of the potential misstatement, its implications for financial statements, and its potential effect on internal controls. This assessment must be conducted in accordance with applicable accounting standards and regulatory requirements, such as those mandated by the Securities and Exchange Commission, SEC, in the U.S. The justification for this approach lies in its adherence to principles of accurate financial reporting and robust internal control frameworks, which are fundamental to investor protection and market integrity. It ensures that any identified issues are addressed systematically, and that disclosures are made in a timely and transparent manner, as required by regulations. An incorrect approach would be to dismiss the potential misstatement without a thorough investigation. This failure to act would violate the company's obligation to maintain accurate financial records and to implement effective internal controls over financial reporting, as stipulated by regulations like the Sarbanes-Oxley Act (SOX). Another incorrect approach would be to attempt to correct the misstatement internally without proper documentation or consultation with relevant experts, potentially leading to further errors or non-compliance with disclosure requirements. This could also involve failing to escalate the issue to the appropriate levels within the organization or to external auditors, thereby circumventing established governance and compliance procedures. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a systematic process of identifying potential issues, assessing their impact, consulting relevant policies and regulations, seeking expert advice when necessary, and documenting all actions taken. Transparency and accountability are paramount throughout this process. Question 12. Process analysis reveals that Vertiv Holdings is preparing to launch a new line of advanced cooling solutions for data centers. To ensure a successful and responsible market entry, which of the following approaches to risk assessment is most aligned with regulatory expectations and professional best practices for Vertiv Holdings? Option A. Rely on informal discussions and the experience of key personnel to gauge potential risks without a formal assessment process. Option B. Expedite the product launch by focusing primarily on market demand and competitive positioning, with a minimal review of potential risks. Option C. Conduct a comprehensive risk assessment that identifies potential operational, financial, compliance, and reputational risks, evaluates their likelihood and impact, and develops targeted mitigation strategies. Option D. Prioritize the financial viability of the new product line, with risk assessment limited to factors directly impacting profitability. Correct answer is C. Conduct a comprehensive risk assessment that identifies potential operational, financial, compliance, and reputational risks, evaluates their likelihood and impact, and develops targeted mitigation strategies. Explanation. Scenario analysis. This scenario presents a professional challenge for Vertiv Holdings employees by requiring them to identify and mitigate potential risks associated with a new product launch. The challenge lies in balancing the need for innovation and market competitiveness, with the imperative to comply with regulatory requirements and maintain ethical business practices. Employees must exercise sound judgment to assess the likelihood and impact of various risks, ensuring that Vertiv Holdings operates responsibly and avoids potential legal, financial, and reputational damage. Correct approach analysis. The correct approach involves a comprehensive and proactive risk assessment process. This entails identifying potential risks across various categories, e.g., operational, financial, compliance, reputational, evaluating their likelihood and potential impact, and developing appropriate mitigation strategies. This aligns with the principles of good corporate governance and regulatory compliance, which mandate that companies establish robust internal controls and risk management frameworks. For Vertiv Holdings, this systematic approach ensures that potential issues are addressed before they escalate, safeguarding the company and its stakeholders. Incorrect approach is analysis, an approach that prioritizes speed to market above all else, neglecting thorough risk evaluation, is professionally unacceptable. This failure to conduct due diligence can lead to significant regulatory breaches, product defects, and severe reputational damage, directly contravening the spirit and letter of regulatory frameworks that demand responsible product development and market entry. An approach that focuses solely on financial projections without considering the operational and compliance risks associated with a new product launch is also flawed. This narrow perspective ignores potential disruptions, safety concerns, or legal liabilities that could undermine the financial success and long-term viability of the product and Vertiv Holdings itself. Regulatory bodies expect a holistic view of risk, not just a financial one. An approach that relies on anecdotal evidence or the opinions of a few individuals without a structured assessment process is insufficient. This subjective method lacks the rigor required to identify all potential risks and their true impact, potentially leading to oversight of critical issues that could have serious regulatory and ethical consequences for Vertiv Holdings. Professional reasoning. Professionals at Vertiv Holdings should adopt a structured and systematic risk assessment framework. This involves 1. Clearly defining the scope of the assessment. 2. Identifying all potential risks. 3. Analyzing the likelihood and impact of each risk. 4. Prioritizing risks based on their severity. And 5. Developing and implementing appropriate mitigation and contingency plans. This process should be documented and regularly reviewed to ensure ongoing effectiveness and compliance with relevant regulations and ethical standards. Question 13. Research into Vertiv Holdings' internal procedures for handling potentially market-moving information. An employee discovers a significant, undisclosed positive development that is expected to be announced next week. The employee is aware that the company's stock price is likely to increase upon public disclosure. What is the most appropriate course of action for the employee to take, strictly adhering to U.S. securities regulations? Option A. Trade Vertiv Holdings securities based on the expectation of the upcoming positive announcement. Option B. Immediately report the development to Vertiv Holdings Compliance Department and refrain from any trading of Vertiv Holdings securities until the information is publicly disclosed. Option C. Share the information with a close friend who works in a different department, with the understanding that they will not trade. Option D. Delay reporting the development to the Compliance Department until after the company's next scheduled trading window closes. The correct answer is B. Immediately report the development to Vertiv Holdings Compliance Department and refrain from any trading of Vertiv Holdings securities until the information is publicly disclosed. Explanation. This scenario presents a professional challenge due to the potential for conflicts of interest and the need to maintain the integrity of Vertiv Holdings' financial reporting and compliance processes. The core difficulty lies in balancing the need for timely information with the strict regulatory requirements for disclosure and the prevention of insider trading. Careful judgment is required to ensure that all actions taken by employees adhere to the specified regulatory framework for the Vertiv Holdings hiring assessment test, which we will assume for this question is the U.S. Securities and Exchange Commission, SEC, regulations. The correct approach involves prioritizing adherence to SEC regulations regarding material non-public information, MNPI. This means that any employee who possesses MNPI must refrain from trading Vertiv Holdings securities or tipping off others until the information has been publicly disclosed through appropriate channels. This approach is correct because it directly aligns with Section 10(b) of the Securities Exchange Act of 1934 and SEC Rule 10b-5, which prohibit fraud, deception, or manipulation in connection with the purchase or sale of securities. It also upholds the ethical obligation of fairness and equal access to information for all investors, An incorrect approach would be to proceed with trading based on the expectation of future positive news. This is a direct violation of insider trading laws, as it involves trading on MNPI. The regulatory failure here is the disregard for the prohibition against trading while in possession of material, non-public information, which can lead to severe penalties for both the individual and the company. Another incorrect approach would be to share the information with a trusted colleague who is not directly involved in the reporting process, with the understanding that they will not trade. This constitutes tipping and is also a violation of insider trading regulations. The regulatory failure lies in the dissemination of MNPI to individuals who are not authorized to receive it, even with an expectation of non-trading, as it creates an unacceptable risk of the information being misused or inadvertently disclosed. A further incorrect approach would be to delay the internal reporting of the positive development to the compliance department until after the trading window has closed. This is problematic because it obstructs the company's ability to manage its disclosure obligations effectively and could be seen as an attempt to circumvent regulatory requirements. The ethical and regulatory failure here is the obstruction of internal compliance procedures and the potential for creating an uneven playing field for investors by withholding information that should be managed through proper disclosure channels. The professional decision-making process for similar situations should involve a clear understanding of the company's insider trading policy, which should be aligned with SEC regulations. When faced with potential MNPI, the immediate step should be to consult with the compliance department or legal counsel. This ensures that any actions taken are in full compliance with the law and company policy, safeguarding both the individual and Vertiv holdings from regulatory scrutiny and reputational damage. The guiding principle is always to err on the side of caution and transparency when dealing with potentially material information. Question 14. Risk assessment procedures indicate a potential disruption in the supply chain for a critical component used in Vertiv Holdings' data center infrastructure solutions. This disruption could lead to delays in product delivery and potential increases in the cost of goods sold. What is the most appropriate approach for Vertiv Holdings to assess the impact of this risk? Option A. Focus on mitigating the operational aspects of the supply chain disruption by sourcing alternative suppliers, deferring a detailed financial assessment until the situation stabilizes. Option B. Rely on historical data from similar past disruptions to estimate the financial impact, without conducting a specific analysis for the current situation. Option C. Conduct a detailed financial impact analysis to quantify potential revenue loss, increased costs, and inventory valuation adjustments, and assess the adequacy of existing disclosures related to supply chain risks. Option D. Immediately communicate the risk to investors, emphasizing the potential for delays and cost increases without a thorough quantification of the financial impact. The correct answer is C. Conduct a detailed financial impact analysis to quantify potential revenue loss, increased costs, and inventory valuation adjustments, and assess the adequacy of existing disclosures related to supply chain risks. Explanation. This scenario presents a professional challenge because Vertiv Holdings, as a publicly traded company, must adhere to stringent regulatory requirements regarding financial reporting and disclosure. The pressure to meet market expectations and the potential for significant financial implications create a complex environment where ethical judgment and regulatory compliance are paramount. A hasty or incomplete impact assessment could lead to misstatements, regulatory penalties, and damage to the company's reputation. The correct approach involves a comprehensive and systematic evaluation of the potential impact of the identified risk on Vertiv Holdings' financial statements and disclosures. This includes identifying all affected accounts, quantifying the potential financial impact, and determining the necessary adjustments or disclosures. This approach aligns with the principles of accurate financial reporting, investor protection, and compliance with accounting standards and securities regulations. Specifically, it reflects the requirements of generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS, depending on the applicable jurisdiction, and the oversight of regulatory bodies like the Securities and Exchange Commission, SEC, in the U.S. An incorrect approach that focuses solely on the immediate operational disruption without considering the financial reporting implications would fail to meet regulatory obligations. This could lead to material misstatements in financial reports, violating accounting standards and potentially securities laws. Another incorrect approach that prioritizes minimizing immediate costs over thorough analysis risks overlooking significant financial impacts, leading to non-compliance and potential penalties. Third incorrect approach that relies on anecdotal evidence or incomplete data would not provide the robust support necessary for accurate financial reporting and could result in misjudgments with serious consequences. Professionals should employ a structured decision-making process that begins with a clear understanding of the identified risk. This involves gathering all relevant information, assessing its potential impact across all affected areas, including financial reporting, consulting with relevant experts, e.g., accounting, legal, and documenting the assessment and any resulting actions. The process should prioritize accuracy, completeness, and compliance with all applicable regulations and ethical standards. Question 15. Comparative studies suggest that when a company like Vertiv Holdings identifies a potential issue that could materially impact its financial statements or operational performance, the initial response is critical for maintaining market confidence and regulatory compliance. Considering the stringent reporting requirements applicable to publicly traded companies, which of the following initial actions best aligns with regulatory frameworks and professional ethics? Option A. Delay any public or regulatory disclosure until the internal investigation is fully complete and all potential ramifications are definitively understood, to avoid premature or inaccurate statements. Option B. Prioritize managing external perceptions by issuing a brief statement acknowledging a potential issue without detailing its scope or impact, while concurrently working on a full internal investigation. Option C. Immediately initiate a comprehensive impact assessment to quantify the potential financial and operational effects, and based on its findings, prepare a timely and accurate disclosure to relevant regulatory bodies and the market. Option D. Inform key institutional investors and analysts about the potential issue privately to gauge their reactions before making a public announcement. The correct answer is C. Immediately initiate a comprehensive impact assessment to quantify the potential financial and operational effects, and based on its findings, prepare a timely and accurate disclosure to relevant regulatory bodies and the market. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the imperative to adhere to stringent regulatory requirements. Vertiv Holdings, like any publicly traded entity, must navigate the complex landscape of financial reporting and disclosure. The challenge lies in balancing the need for timely information to investors with the absolute necessity of accuracy and compliance, especially when dealing with potentially material events. Careful judgment is required to ensure that all disclosures are not only truthful, but also meet the specific standards set by the relevant regulatory bodies. The correct approach involves a thorough and documented impact assessment that meticulously evaluates the potential financial and operational consequences of the identified issue. This assessment must then inform a timely and accurate disclosure to regulatory authorities and the market, adhering strictly to the reporting timelines and content requirements stipulated by the Vertiv Holdings governing jurisdiction securities laws and stock exchange listing rules. This ensures transparency, protects investors, and maintains market integrity, fulfilling ethical obligations and regulatory mandates. An incorrect approach that prioritizes immediate market perception over regulatory compliance would fail to conduct a comprehensive impact assessment. This could lead to premature or incomplete disclosures, potentially misrepresenting the situation to investors and regulators. Such an action would violate the principles of accurate and timely disclosure, risking regulatory penalties, reputational damage, and loss of investor confidence. Another incorrect approach that delays disclosure until internal investigations are fully concluded without any interim communication also poses significant risks. Thoroughness is important. An undue delay in acknowledging a material issue, even if the full extent is not yet known, can be interpreted as an attempt to mislead the market. This violates the spirit and letter of regulations requiring prompt notification of potentially significant events. A third incorrect approach that involves selectively disclosing information only to certain stakeholders would be a severe breach of regulatory and ethical standards. This creates an uneven playing field for investors, and is strictly prohibited by insider trading regulations and fair disclosure rules. The professional decision-making process for similar situations should involve a structured approach. First, identify the potential issue and its materiality. Second, initiate an immediate, albeit preliminary, impact assessment. Third, consult with legal and compliance teams to understand specific disclosure obligations and timelines. Fourth, prepare and disseminate accurate and complete disclosures within the mandated timeframe. And finally, continue to monitor and update disclosures as new information becomes available. This systematic process ensures that all regulatory and ethical considerations are addressed. Question 16. The risk matrix shows a high probability of a significant market shift impacting Vertiv Holdings' competitive landscape, stemming from an unconfirmed rumor about a competitor's impending acquisition. A senior executive has received this rumor through informal channels and is considering its implications for Vertiv's strategic planning and potential investment decisions. Option A. Consult with Vertiv Holdings' legal and compliance departments to assess the nature of the information and determine appropriate next steps. Option B. Immediately incorporate the unconfirmed rumor into strategic planning and investment models to ensure Vertiv Holdings is prepared for the market shift. Option C. Disregard the rumor entirely as it is unconfirmed and therefore not actionable for strategic decision-making. Option D. Share the rumor with key operational teams to gather their immediate reactions and potential impacts on their respective areas. The correct answer is B. Immediately incorporate the unconfirmed rumor into strategic planning and investment models to ensure Vertiv Holdings is prepared for the market shift. Explanation. This scenario is professionally challenging because it requires balancing the immediate need for information with the regulatory obligations to protect sensitive client data and maintain confidentiality. Vertiv Holdings, as a publicly traded company, operates under strict regulatory frameworks that govern how it handles non-public information, especially in the context of potential mergers or acquisitions. The pressure to make a swift decision based on incomplete information, while also adhering to compliance, demands careful judgment and a robust decision-making process. The correct approach involves seeking clarification and guidance from the legal and compliance departments before proceeding. This is the best professional practice because it ensures that any actions taken by Vertiv Holdings are in full compliance with relevant regulations, such as those governing insider trading and the disclosure of material non-public information. Specifically, under U.S. securities laws, trading on material non-public information is prohibited. By involving legal and compliance, Vertiv can ensure that the information is properly vetted, its materiality assessed, and that appropriate procedures are followed to prevent any violations. This proactive engagement safeguards the company from legal repercussions, reputational damage, and ensures ethical conduct. An incorrect approach would be to immediately use the information to inform the investment decision without further verification. This fails to acknowledge the potential for the information to be material non-public information, which could lead to insider trading violations under U.S. securities laws. Another incorrect approach would be to disregard the information entirely without consulting relevant departments. While this avoids potential violations, it could also mean missing a critical strategic opportunity due to an overly cautious stance, and it doesn't demonstrate a proactive approach to risk management and information assessment. A third incorrect approach would be to share the information broadly within the company without a clear need to know or proper controls, which could inadvertently lead to leaks and further compliance issues. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves 1. Identifying the nature of the information received and its potential implications. 2. Consulting with internal legal and compliance teams to understand the regulatory landscape and company policies. 3. Assessing the materiality and non-public nature of the information. 4. Developing a plan of action that aligns with legal requirements and ethical standards, which may include further investigation, controlled dissemination, or appropriate disclosure. Question 17. Regulatory review indicates that during the Vertiv Holdings hiring assessment test process, a candidate discovers they have a close personal acquaintance who is also a candidate for the same position. The candidate is aware of the potential for perceived or actual bias. What is the most ethically sound and compliant course of action for the candidate to take? Option A. Withdraw from the assessment entirely to avoid any appearance of conflict, even if they are a strong candidate. Option B. Immediately disclose the personal acquaintance to the hiring manager or relevant assessment administrator, and recuse themselves from any further involvement in the assessment process that could influence the outcome for their acquaintance. Option C. Proceed with the assessment as normal, focusing solely on their own qualifications, and assume that their personal relationship will not impact the fairness of the process. Option D. Discreetly advocate for their acquaintance to the hiring manager, highlighting their acquaintance's strengths without explicitly mentioning the personal relationship. The correct answer is B. Immediately disclose the personal acquaintance to the hiring manager or relevant assessment administrator, and recuse themselves from any further involvement in the assessment process that could influence the outcome for their acquaintance. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet financial targets can create a conflict of interest, potentially leading individuals to overlook or downplay ethical concerns. Careful judgment is required to ensure that decisions are not solely driven by short-term gains, but also by a commitment to integrity and adherence to the Vertiv Holdings hiring assessment tests specified regulatory framework. The correct approach involves prioritizing transparency and adherence to the Vertiv Holdings hiring assessment tests regulatory framework. This means acknowledging the potential conflict of interest and seeking guidance from appropriate internal or external compliance resources. By proactively addressing the issue and ensuring all actions align with the established guidelines, the individual upholds their ethical responsibilities and protects Vertiv Holdings from potential regulatory repercussions. This approach demonstrates a commitment to ethical conduct and robust compliance, which are paramount in any professional setting, especially within the context of a hiring assessment. An incorrect approach would be to proceed with the hiring decision without disclosing the potential conflict of interest. This failure to disclose is a direct violation of ethical principles and likely contravenes specific guidelines within the Vertiv Holdings hiring assessment test regulatory framework that mandate disclosure of such situations. It creates an environment where decisions might be perceived as biased, undermining the integrity of the hiring process. Another incorrect approach is to ignore the potential conflict and rationalize the decision based on the candidate's qualifications alone, without considering the implications of the personal relationship. This demonstrates a lack of due diligence and an ethical blind spot. It fails to recognize that even if the candidate is the most qualified, the appearance of impropriety can damage trust and create future complications, potentially violating principles of fairness and equal opportunity that are often embedded in regulatory frameworks. Finally, an incorrect approach would be to attempt to subtly influence the hiring process to favor the acquaintance without explicit disclosure. This is a form of unethical manipulation and a breach of trust. It directly undermines the fairness and objectivity of the hiring assessment and is a serious ethical lapse that could have significant regulatory consequences. The professional decision-making process in such situations should involve a clear understanding of the relevant regulatory framework and ethical codes. When a potential conflict of interest arises, the first step is to identify it clearly. Next, one should consult the applicable policies and guidelines, such as those stipulated by the Vertiv Holdings hiring assessment test. If uncertainty remains, seeking advice from a supervisor, HR department, or compliance officer is crucial. Transparency and documentation of the process are essential to demonstrate good faith and adherence to standards. Question 18. Consider a scenario where a team at Vertiv Holdings is tasked with optimizing the financial reporting process to reduce cycle times and improve accuracy. They propose implementing a new automated system that significantly alters how revenue is recognized and expenses are categorized. Which of the following approaches best aligns with regulatory requirements and ethical best practices for Vertiv Holdings? Option A. Bypass certain standard internal control checks within the new system to expedite the reporting process, assuming the overall accuracy will be maintained by the automation. Option B. Implement the new automated system immediately after a brief internal review, prioritizing speed to market and cost savings. Option C. Conduct a comprehensive review of the proposed system's impact on all relevant financial reporting regulations and internal controls, involving the legal and compliance departments, and thoroughly document all changes and their justifications before implementation. Option D. Modify the system to recognize revenue earlier than current standards, allow to demonstrate improved financial performance, arguing it's a necessary step for competitive advantage. The correct answer is B. Implement the new automated system immediately after a brief internal review, prioritizing speed to market and cost savings. Explanation. This scenario presents a professional challenge for Vertiv Holdings employees by requiring them to balance the pursuit of efficiency with adherence to regulatory compliance and ethical conduct. The core difficulty lies in identifying and implementing process improvements that do not inadvertently lead to breaches of financial reporting standards or market manipulation. Careful judgment is essential to ensure that any optimization efforts are transparent, fair, and do not create an unfair advantage or mislead stakeholders. The correct approach involves a thorough review of existing processes, focusing on identifying redundancies, bottlenecks, and areas where automation or streamlining can occur without compromising data integrity or regulatory compliance. This approach prioritizes understanding the underlying regulatory framework, such as the Securities Exchange Act of 1934 and its related rules concerning financial reporting and disclosure, as well as any specific industry guidelines applicable to Vertiv Holdings. By engaging relevant compliance and legal teams and ensuring that all proposed changes are documented and vetted against these regulations, employees can confidently pursue process optimization. This ensures that improvements enhance efficiency while upholding the company's commitment to accurate financial reporting and fair market practices, thereby preventing potential legal repercussions and reputational damage. An incorrect approach that focuses solely on cost reduction without considering the impact on financial reporting processes would be professionally unacceptable. This could lead to the elimination of controls or checks that are crucial for accurate financial data, potentially violating Sarbanes-Oxley Act, SOX, requirements for internal controls over financial reporting. Another incorrect approach that involves manipulating sales figures or revenue recognition to meet short-term targets, even under the guise of process improvement, is a direct violation of accounting principles and securities laws, constituting fraud and market manipulation. Such actions undermine investor confidence and carry severe legal penalties. A third incorrect approach that prioritizes speed of implementation over thorough testing and validation of new processes could result in errors in financial reporting, leading to restatements and regulatory scrutiny. Professionals should employ a decision-making framework that begins with a clear understanding of the objectives, followed by a comprehensive assessment of potential impacts, particularly concerning regulatory compliance and ethical considerations. This involves proactive consultation with compliance, legal, and internal audit departments. Any proposed process change should be evaluated against established regulatory requirements and ethical standards. Documentation of the rationale, potential risks, and mitigation strategies is crucial. When in doubt, seeking guidance from senior management or the compliance department is paramount. Question 19. The efficiency study reveals that while Vertiv Holdings has achieved significant cost savings in its supply chain operations, there are also emerging inefficiencies in its customer service response times. The executive team is keen to present a unified message of strong performance to investors. Which of the following approaches best reflects professional and regulatory compliance for reporting these findings? Option A. Highlight the customer service inefficiencies as a critical systemic failure to justify a significant restructuring, while minimizing the impact of the cost savings. Option B. Request the study be re-evaluated to identify any potential errors that might have inflated the reported cost savings, thereby creating a more balanced narrative. Option C. Present a comprehensive report detailing both the cost savings and the customer service inefficiencies, alongside a strategic plan to address the identified service issues. Option D. Focus the investor communication solely on the significant cost savings achieved, downplaying or omitting any mention of the customer service response time issues. The correct answer is C. Present a comprehensive report detailing both the cost savings and the customer service inefficiencies, alongside a strategic plan to address the identified service issues. Explanation. This scenario is professionally challenging because it requires balancing the company's desire for operational improvement with the ethical and regulatory obligations to maintain data integrity and prevent misleading reporting. Vertiv Holdings, as a publicly traded company, is subject to stringent regulations regarding financial disclosures and operational reporting. Misrepresenting data, even with the intention of highlighting areas for improvement, can lead to severe consequences, including regulatory penalties, reputational damage, and loss of investor confidence. The core of the challenge lies in distinguishing between genuine operational analysis and the manipulation of data for a desired narrative. The correct approach involves transparently presenting the findings of the efficiency study, including both positive and negative aspects, and then proposing actionable strategies for improvement based on the complete data. This aligns with regulatory frameworks that mandate accurate and complete disclosure of material information. Ethically, it upholds the principle of honesty and integrity in reporting. By acknowledging all findings, Vertiv Holdings demonstrates a commitment to genuine operational excellence and responsible corporate governance, which is crucial for maintaining trust with stakeholders and complying with regulations like those overseen by the SEC, assuming U.S. jurisdiction for this assessment. An incorrect approach that focuses solely on negative metrics to justify a particular strategic direction, while omitting positive findings or contextual information, constitutes a misrepresentation of the study's results. This can be seen as a violation of accounting principles and disclosure requirements, as it creates a skewed perception of the company's performance. Such an action could be interpreted as an attempt to manipulate perceptions rather than to genuinely improve operations, potentially leading to regulatory scrutiny for misleading statements. Another incorrect approach that involves selectively highlighting data points that support a predetermined conclusion, while downplaying or ignoring contradictory evidence, is also ethically and regulatorily unsound. This practice undermines the objectivity of the study and can lead to flawed decision-making. It fails to provide a holistic view of the company's operational status, which is essential for informed strategic planning and accurate reporting. Finally, an approach that involves altering or fabricating data to present a more favorable or a more dire picture than reality, regardless of the intended outcome, is a direct violation of ethical conduct and regulatory mandates. This constitutes fraud and can result in severe legal repercussions. Professional decision-making in such situations requires a commitment to data integrity, transparency, and adherence to all applicable regulatory guidelines. Professionals must always prioritize accurate reporting and ethical conduct over short-term gains or the appearance of progress. Question 20. The investigation demonstrates that a senior executive at Vertiv Holdings is pressuring the accounting department to recognize revenue from a large, pending contract in the current quarter, even though the contract terms indicate that revenue should only be recognized upon project completion in the next quarter. The executive argues that this will significantly improve Vertiv Holdings' quarterly earnings and positively impact stock performance. What is the most appropriate course of action for the accounting department to take in this situation? Option A. Recognize the revenue in the current quarter as requested by the executive to meet performance targets. Option B. Seek legal advice on how to interpret the contract terms to allow for current quarter revenue recognition. Option C. Accurately recognize the revenue in the next quarter when the contract terms dictate, and document the executive's request and the department's decision. Option D. Inform the executive that the request cannot be fulfilled and cease all communication on the matter. Correct answer is A. Recognize the revenue in the current quarter as requested by the executive to meet performance targets. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical and regulatory obligations. Vertiv Holdings, as a publicly traded entity, is subject to stringent regulations regarding financial reporting and disclosure. The pressure to meet quarterly earnings targets can create an environment where individuals might be tempted to overlook or misrepresent information. Careful judgment is required to ensure that all actions align with legal mandates and ethical principles, even when faced with internal pressure or the desire for favorable outcomes. The correct approach involves a commitment to transparency and adherence to accounting standards. This means accurately reflecting the financial position of Vertiv Holdings, even if it means reporting a less favorable outcome in the short term. This approach is ethically sound and legally compliant, as it upholds the principles of accurate financial reporting and investor protection, which are fundamental to maintaining market integrity and stakeholder trust. Regulatory frameworks, such as those overseen by the Securities and Exchange Commission, SEC, in the U.S., mandate truthful and complete financial disclosures. An incorrect approach would be to manipulate the timing of revenue recognition to artificially inflate current quarter earnings. This action constitutes accounting fraud and violates the principles of Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS, depending on the applicable jurisdiction. Such manipulation misleads investors and can lead to severe legal penalties, reputational damage, and personal liability for those involved. Another incorrect approach would be to delay the recognition of necessary expenses or provisions. This also distorts the true financial picture of Vertiv Holdings, creating a false sense of profitability. This practice is a form of financial misrepresentation and is prohibited by regulatory bodies. It erodes investor confidence and can have significant repercussions when the true financial state is eventually revealed. A third incorrect approach would be to selectively disclose information, providing a positive spin on unfavorable data while omitting critical details. This lack of full disclosure is deceptive and violates the duty of candor owed to investors and the market. Regulatory bodies require comprehensive and unbiased reporting of all material information. The professional reasoning framework for such situations involves a hierarchical assessment of duties. First, adherence to legal and regulatory requirements. Second, upholding ethical principles. And third, considering the company's best interests, which are ultimately served by maintaining integrity and trust. When faced with conflicting pressures, professionals should always prioritize legal and ethical compliance. They should seek clarification from legal counsel or compliance departments if unsure about the appropriate course of action, and be prepared to document their decision-making process.